Hi, my name is Samer Halal and we're here to talk about IRAs. The acronym IRA stands for Individual Retirement Account. There are multiple types of IRAs, but the main two are traditional IRAs and Roth IRAs. Traditional IRAs allow the owner to make pre-tax contributions or to get a deduction of their contributions. So hypothetically speaking, a person who's making $100,000 a year, they make a $5,000 contribution into an IRA. They get to deduct that from their income, so they only pay income tax on $95,000. Versus somebody who makes a contribution in a Roth IRA will not get any tax benefit in the year they make the contribution. After the contributions are made, the money is invested in some sort of a vehicle, and then the money grows tax deferred. So tax deferral is extremely important because as the money is compounding over time, whether it's generating interest or dividends or capital gain based on the investment it's in, there's nothing being reported to the IRS and there's no taxes to be paid along the way as long as the money stays inside the IRA. And that works for both the traditional and the Roth. In retirement, when you start to take withdrawals from your IRA, that's when potentially there's tax consequences. So for the traditional IRA, the entire amount is taxable at the person's tax bracket that year where they take the withdrawal. Versus in the Roth, there is no taxes on the distributions or on the withdrawals. So let's take a hypothetical example of a 20-year-old who's at a 15% marginal tax bracket and is making a $5,000 contribution, and they have two choices to either make the contribution into a traditional IRA or a Roth IRA. If they make it into a traditional IRA, they get to save $750 on their tax bill that year. That's 15% times $5,000. Versus if they make the contribution into a Roth IRA, they will get no benefit in the year they make it. Let's say they happen to be generating a rate of return of 7.2% per year on average. That's the return where the money doubles every 10 years. So their $5,000 at 20 years old becomes $10,000 when they're 30, which becomes $20,000 when they're 40. When they're 50, the 20 becomes $40,000, and then it becomes $80,000 when they're 60. So a $5,000 contribution through compounding turned into an $80,000 account at 60 years old, right? If this was in a traditional IRA, then the entire $80,000 is taxable at the time of withdrawal. Imagine that you got a benefit of $750, but then they have to pay taxes on $80,000 as income. Versus if the money was in a Roth and they got no tax break at the time of the contribution, no tax benefit, but now they have $80,000 that is fully tax-free under certain qualifications. So this is really highlights the power of the Roth. This video is really designed to highlight the importance of the Roth when you have years of compounding and how tax deferral turns into tax-free at withdrawal time and retirement. That's the example only highlighted 1 year worth of contribution. Imagine if you're making contributions year after year for multiple years. That could be very significant. So ultimately, the outcome would depend on your own situation and circumstances, how the money is being invested all throughout, the average rate of return, how much contributions you put in, and all of that. But the basic concept is the same: tax deferral and turning into tax-free at the time of withdrawal. Whether the Roth IRA makes any sense for you or for any of the people you care about, it depends on your own situation and it depends on your qualifications. If you have questions, let's talk.